Market direction. Let's start with the fundamentals of the price chart. Identifying the market direction. Supply or demand. Who is in control? Identifying the market direction is generally the first step in analyzing a price chart. We want to identify the trend and determine whether buyers or sellers are in control. We always aim to trade in the same direction as the controlling side of the market to increase the win rate. How does the system work? The system works based on mitigations. When the price mitigates a demand level, demand takes control over supply. Conversely, when the price mitigates a supply zone, supply takes control over demand. Imagine the price is moving in an uptrend, creating a series of higher highs and higher lows. Each time the price breaks structure to the upside, a demand zone is formed. These demand zones remain unmitigated until the price returns to them, offering a good opportunity to follow the trend. However, if the price breaks below a demand level, forming a change of character, it indicates that supply is now in control over demand, and the market has formed valid supply zones. The price keeps moving down, creating new supply levels until it reaches the next demand zone that has not been used yet. At this point, there is a fight between supply and demand, and we need to wait to see which side wins. You should watch these levels closely. A clean break and retest can give good trade setups, while false breakouts can trap traders who enter too early. Here we have a series of higher highs and higher lows, showing that demand is in control. The market sentiment is bullish, so the price is more likely to continue pushing higher. The direction will remain bullish, and we will only look for long opportunities as long as the price stays above the recent demand zone. So let's see what will happen. The market tests the demand level but fails to create a new high because buyers are not strong enough, and eventually the price breaks below the supply area. Now we can say that buyers are no longer in control, and a reversal is on the way. If we treat these points as the beginning of the impulsive move that shifted the market structure, then they become our supply zones. From there, the market keeps breaking structures to the downside, showing that supply is in control. Another supply zone forms and the price reaches the next unmitigated demand area ahead. This demand zone can be an area of interest for buyers to step back into the market. At this stage, there is a battle between buyers and sellers, and we need to wait and watch the price action to see who takes control. It is important to remember that we cannot control the market. What we can do is prepare ourselves for the different scenarios that may happen. Number 2, liquidity. In technical analysis, liquidity is an area on the chart where many pending orders and stop losses are placed. Imagine if this is our recent price action. If the price pulls back to this support area, many traders see it as a buying opportunity because it has acted as both support and resistance recently, making it a strong market structure level that can push the price higher. But smart money sees it as an opportunity to collect liquidity. If they want to buy this asset, they need sellers in the market. In other words, they need liquidity. When retail traders enter at this level, they usually place their stop losses just below it. Smart money hunts these stops to gather liquidity to fill their own buying orders. In another example, imagine smart money wants to sell this pair. To do that, they need liquidity to fill their large orders. So, where is the liquidity? Liquidity exists where retail traders enter the market. Here, we have an area of resistance that has rejected the price multiple times. If the price returns to this zone, many traders will go short, placing their stop losses just above it. This means the liquidity is above the zone. To hunt these stops, smart money needs to push the price higher to trigger the stop losses and fill their orders. Also, when the price breaks above this resistance, many breakout traders will enter the market, expecting the price to continue higher. Their buy orders also become the liquidity smart money needs. Once smart money gathers the required liquidity, the price will drop, trapping retail traders on both sides. Now, we've covered the general idea of liquidity. But the real question is, why should we mark these zones on the chart? Let's look at the main reasons. Number 1. Identifying potential targets for price. The market moves toward liquidity zones because it is required for future movements. So we mark these levels as targets for our trades. For example, if there's a major liquidity zone below the price, the market may push the price there to grab that liquidity. By marking these levels, we can anticipate where the price is likely to go next instead of guessing. Number 2. Avoid getting trapped. We know that manipulation happens around liquidity levels most of the time. By recognizing where these levels are, you can stay on the right side of the market and avoid being caught in false moves. Number 3. Plan trades with higher probability. Once you know where liquidity sits, you can plan entries, exits, and stop losses more strategically. For example, you might wait for the price to sweep liquidity and then enter in the direction of the next move. This gives you a higher chance of success than randomly jumping into the market without context. It's worth mentioning that, in an uptrend, the liquidity below swing lows is more important than the liquidity above swing highs. This is because when the market pulls back, smart money often targets those swing lows to collect sell-side liquidity before pushing the price higher again. These levels act as strong support zones where stops and pending sell orders are clustered, giving the market a chance to fuel the next upward move. Similarly, in a downtrend, the liquidity above swing highs becomes more important, as the market often sweeps these areas to collect buy-side liquidity before continuing lower. Now, it's time to understand what happens around these levels and how the liquidity grab pattern works. A bullish liquidity grab pattern happens when the price wicks below a liquidity level or even closes below it, but then quickly returns inside the range. Now, what does this show in terms of price action? It means that the market was reaching for liquidity below the support by triggering stop losses and trapping breakout traders. This is often a strong signal that the market is likely to move in the opposite direction of the liquidity grab. For example, if price sweeps above Asian high during the London opening but then quickly closes back below the level, it shows buyers have been trapped. This gives traders a chance to look for short setups, expecting the price to reverse and move lower. The same logic works for a bearish liquidity grab pattern. A bearish liquidity grab pattern occurs when the price moves above a key liquidity level, triggers stop losses and buy orders, but then quickly reverses and closes back below that level. This shows that buyers have been trapped and selling pressure has taken control, often leading to a move lower. For example, in a clear downtrend, if the market gathers enough liquidity, the next downward movement is likely to occur, creating a short trading opportunity. When a liquidity grab pattern forms at a resistance level, it can be a strong signal that the market is likely to move downward. Now, the liquidity grab pattern is an early reversal sign, but in order to make it more reliable, you can combine it with the change of character.